the market has done something that I didn't expect and I was wrong. So I have to recalibrate myself and say, okay, what did I expect before I took the nap or before I went to bed? And then when I go into the economic calendar, I have that reminded because if I expect something to come into the marketplace in terms of volatility, that's what the high impact and medium impact news drivers are for. We want to know when it's likely to increase in volatility. Okay, it's one thing to be like in an earnings season. Like in earnings season, futures, they get wild many times after the close. Okay, and we also know that in Forex, we don't really have earnings season, but we do have economic drivers that come out and they're set to a specific day and time, much like a TV guide. Okay, I'm a child of the 70s. I was born in 1972. And when we grew up, all you young guys and gals out there are used to having the TV guide or the guide on your remote. You push your button and it tells you what's on TV right now and what channel. And you can scroll ahead in time and see what's on. We only had that luxury with a little magazine, and it was a TV guide and it was published every week. Well, these events or topic or not topics, but these events and or opportunities in trading are basically scheduled like TV programs. Okay, your high impact and medium impact news drivers are scheduled well in advance. Like you can see 2-3 weeks from now when these things are coming. So you're not surprised by it, or you shouldn't be. Okay. So by having that understood and what days of the week are likely to create these increases in volatility, so you know what that volatility is going to bring with it the strong likelihood of manipulation. And that's one of the key factors or ingredients to what we're looking for smart money. We want to see some type of manipulation. And I'll get to what that manipulation should look like in a moment. But I'm referring to the economic calendar, making sure rather that I'm in front of the charts for the right reasons and I'm following the right market. So if you're a Forex trader, you want to be looking for your pairs that have the currency news driver that has a high or medium impact news driver coming out around it. It'll tell you the time. And most of the time it's 8:30 in the morning, or if it's US based, it may be something like 9:30 or 10 or 10:30, like for crude oil inventories. And you can trade Canadian dollar, just on that report alone. But referring to your previous session or before you went to sleep's analysis, is that still hold true? Or does it hold true? Or has something changed while you were away from the charts? If it hasn't changed, then you go through the process of trusting it. And what type of analysis would that be? Well, number one, I start everything on Saturday. And I look at what I think that weekly chart's trying to go to. Is it going higher or is it going lower? I'm not trying to predict Friday's closing price. I don't teach my students to try to predict the Friday closing price, okay? So many folks have listened to me, taken things out of context, and spread so much misinformation about what it is I do as a trader, how I teach as a mentor, and what my students are focusing on or should be focusing on. They have made so much more confusion. And this is why another reason why I hate when people try to teach my stuff, because you don't know what you're doing. Watching a video, listening to a video series, you don't know. And just repeating what I'm saying, you don't know how to answer a question when someone gives it to you. How do I know? Because those same people that are running mentorships are asking me the questions in my forum so they can answer their customers. Yeah, I know. So if we know that the weekly chart is likely to go higher, now when I say if we know, how do we know? Well, we don't know with 100% surety that it's going to go up or down. Our analysis is never guaranteed. That's why we have to have stop loss. But I want you to think about how when you watch me trade these intraday movements, and I'm on a 1 minute candle. Okay, number one, I'm canceling out all the arguments from the Goldman Sachs boys that say it's just noise and there's no pattern. Okay, there's no consistency or continuity found in lower time frames. These are people that don't know what they're talking about. And you've seen now students and me do this consistently with precision. But what I'm showing you is where I think the market's going to go to, the draw. Okay, that's the first question you need to address on Saturday, or if you do your analysis on Sunday. Some of you are probably listening to this after church. That's fine. But whatever that day is on the weekend, Saturday or Sunday, that that is the day you're focusing on. Where do you think that next candle, when we start trading on Sunday evening and the markets open up, is the market going to expand, not close high or low? Is it going to expand? Is the largest portion of expansion in that weekly candle? And what do I mean by that? If you were to measure the highest high and the lowest low after the week closes, okay, was there more expansion upward or downward? That's the question that I teach my students to aim for answering on the weekend. You're looking for that. Okay. That gives you the absolute strongest bias filter you'll ever fucking find. Okay. Because what you're doing is you're patterning it off of large institutional flows. Ooh, what does that mean? Well, large institutional flows are big funds, big hedge funds, big deep pocket entities. Okay. And they are not trading on 1 minute charts. Okay. They can't put their size into the marketplace on a 1 minute candle. So they require weekly and daily levels. And that order flow that comes through that time frame, that's the elephant. That's the trail of elephant footprints that we're looking for. And smart money is a big elephant. It's lumbering. Okay. It has to take a long time to work in its orders to get into a position. Not the start of a position. Obviously, any position entry that constitutes their participation, obviously, right? But they can't put all of the size that they want on just in one trade. Like you go in and put in your 10 lots or your 5 lots or whatever, and it's done in one clip. Boom, it's done. They don't even break the order up. But large entities and large hedge funds, they have to break their orders up and they scale them in. So they're requiring a longer term price swing. And we derive that from the weekly chart. So the weekly chart, the only thing we're trying to do is capitalize on focusing on the next expansion on that weekly candle, removing the importance of knowing how it's going to close. We don't care. We just know that if that 1 minute candle that I show you example after example after example of how the market moves from a order block or runs out liquidity and runs for buy side liquidity, whether it be a single high or a relative equal high, that draw on liquidity is the focus of where I think price is going to go. I'm holding that trade until I'm stopped out or it reaches that target, the draw on liquidity. So for the sake of argument and understanding, let's just say that we believe that that 1 minute candle that we are trading in is bullish and there's buy side liquidity above relative equal highs. When a trade is entered, or for instance, when I have entered a trade and you watch these videos pan out where the market just keeps going up and up and up, and it might have small little retracements, but it ends up going to where I'm aiming for, and my limit order gets hit. Every individual 1 minute candle, think about that same 1 minute candle as a weekly candle and apply the same logic that I outline in my 1 minute setups. Apply that to that weekly chart. It just takes a whole lot more time to submit to it. So when we're looking at a weekly chart, we're not just trying to guess on the next candle without any kind of logic or rationale behind why it should go up or down. We're looking at where has it been? Did it just take sell side? Has it taken sell side and has yet to trade up into a sell side imbalance, buy side inefficiency? Or has it taken a level of buy side on the weekly chart yet? If it hasn't, guess what? It's likely to continue going up. So that's how easy it is for me to say, I expect this week to have a expansion on the upside on the weekly chart. So if that's the case, that makes me trust initially going in, I want to be in a buy model. So my weekly analysis is framed on, I predominantly want to put my larger positions if I'm going to be trading intraday. I want to be focusing on being a buyer, and I'll do full maximum leverage if the trade is viable. It doesn't mean I won't sell short. It just means that if I do sell short, I have to do half or less than what my full position would be on if I was doing a long in a buy model. I'm going to say that again because you probably just didn't even listen to it. It doesn't mean anything to you because you want to hear something else. But what I just gave you was gold. If my bias for the week is bullish, my largest leverage, pyramiding, building up, using the largest positions I can put on initially and keep adding as equity allows me to do so, I will do that in long positions. If I'm going to go short anytime during that week, I must be at 50% or less of the largest leverage I would use as a trade that week. Because I'm going against what? I'm going against the order flow on the weekly chart. So I'm already building in and tamping down the likelihood of a big drawdown because I'm not opening myself up to potential losing trades with maximum leverage. Just because I'm good and nimble intraday, I'm cognizant that I can be wrong. So I build in these safeguards as best as I can and still be able to engage a short position if I'm in a buy model. But I'm not going to hold on to those shorts very long. I'm going to pick the easiest short direct run to a target and be done with it. And it might go many times farther than where I get out at. And I don't care because I'm going to go right back into looking for the next run on the buy side. You see what I'm saying? I'm filtering out the best of the best. But if I want to participate in a bullish market but sell short, I'm building in all of these ideas that would limit my exposure but still allow me participation. But also reminding myself I'm selling short in a market that I know is more likely to go higher. So I don't want to overstay my welcome. And what does that mean? Holding on to a trade too long or turning it into a swing trade. Or, oh, I was wrong about my weekly analysis. So now I'm going to hold on to this longer and look for even bigger objectives and move my limit orders down farther. And then have it turn against me and stop me out. Even if I've taken partials, I don't like that feeling. I like being out when I want to get out, and I don't mind leaving some meat on the plate. Everybody's got to eat, right? So you're referring to that weekly chart and defining whether or not you're going to be in a buy model or a sell model. And that, again, is defined by, do you believe the largest expansion from the open is going to be up or down? You're not trying to predict that weekly close. That's very liberating. When you come to terms with that, it's not complicated. All you're doing is you're subscribing to the same things that we look for in these intraday charts when the market's still drawing towards a old high or relative equal high, or if you're bearish. Let's just say the weekly candle, you're expecting it to go down, the larger expansion going down, because it has recently, in recent weeks or in months, it has taken buy side and it's been dropping, and you can see clearly it's reaching for an old low, or it's about to reach into an imbalance, a buy side imbalance, sell side inefficiency. If it hasn't reached into it yet, then that means what? I'm going to side with the likelihood of the next weekly candle or the one that's about to open up tonight. And I'm not saying this is the case for this particular week. I'm just giving you the routine. That's what this topic is. Then in those instances, I would be in a sell model. That means I would be doing the largest position in leverage on my shorts. If I'm selling short, I'm going to be willing to use the largest leverage that's available to me. But if I go long anytime during that week, I have to be at 50% or less, whatever my largest maximum leverage would be if I was going short in a bearish week. Okay, very, very important. Very, very important. Those things helped me a lot in my 6th and 7th year. Once I figured out what I was trying to do, that kind of kept me from wrecking myself, because it would be harmful for me to just, I guess, not, to eliminate the idea of getting drunk with the volatility of buying and selling, because I can do both just about any market condition, unless it's a one-way straight, rip rate from like a CPI type of event. you're not doing both directions in that. With those instances put aside, I can buy and sell in a market condition pretty much intraday. I can do both sides. But just because I can, does it mean that I should just do it because I can? No, I want to maximize when it's on the right side, when it's in line with that weekly expansion, because I'm in line with the large flow, large institutional order flow on the weekly chart. If it's bullish, or if I'm anticipating it to be bullish, I want all of my emphasis on being long and the leverage behind those trades to be at the maximum there. I don't want to be maximizing my risk and use the largest leverage in a time when I know in my analysis that it's likely to go higher based on the weekly analysis. I don't want to be going short with the largest leverage, because what I'm doing is I'm inviting the market to whip my ass and to do it the best way it can with the maximum effect. So I want maximum effort on my side. I don't want maximum effort on the risk side where it could punish me, much more than I would want to suffer. So that's the reason why I do that. But when I go through the economic calendar and I remind myself of what I'm looking for and when the volatility should come into the marketplace, when does those high impact or medium impact news drivers come in? And then I'm waiting for that to occur. If my weekly analysis is aiming for or indicates to me through my own interpretation that it's bullish and I'm in a buy model, I prefer to see some kind of bearish drop at that medium or high impact news driver, preferably into some kind of buy side imbalance, sell side inefficiency, or below relative equal lows, or a single 15-minute candle low. Now, 15-minute is my bellwether. Like, I could trade everything in every model that I know. I can use just a 15-minute candlestick chart and do everything I can do. Period. I don't need to drop lower, and I don't need to go any higher. I could just simply trade off that. That is not an invitation for you to say, okay, ICT said that, so now that's what I'm going to do. Your bellwether might be an hourly chart. It might be a 5-minute chart. It might be the daily chart. It might be a 4-hour chart. Don't let me, as your mentor, influence you and you copycat every single thing I say I do. That's the worst thing you can do as a mentee with anyone. You have to bring your own personality, your own influence, the things that are meaningful to you, your signature, your fingerprints. They have to be all over this. You can't just say, I took ICT's 100%, everything he said verbatim, and now it's mine. It might be for some of you, but I don't want that. I'm not trying to create copycats of me. I'm interested, very, very interested to see how all of you adopt this idea and formulate your own approach using the tools and concepts, because it's all going to be slightly different and you're all going to get a unique result, and you can all be positive. You can all be making money on the same day doing different things. That's the beauty of this. It sounds like it can't possibly be like that, but it's exactly how it works. And vice versa. Sometimes you'll have winning trades and other students that'll be doing this very same thing you're trying to do. They'll have the opposite result because they're bringing in their problems, like I mentioned yesterday. What you thought was going to happen on the weekly candle, go revisit that. And here's something also you want to do. You need to have a pen or pencil, some kind of writing instrument, and a pad next to you while you're trading. Because on that piece of paper or that pad, you have your weekly analysis, what you think it's likely to draw to. Because here's the benefit of doing that. If you do not have the expectation of where that weekly chart may be reaching for, you might get completely out of a position that's running right for that and leave 30, 40 handles if you're in S&P, or 80 pips in some instances on a Forex trade, because you just felt like it was time for you to get out and you abandoned where you thought that weekly candle may be reaching for. When I was a younger man, I learned a very hard lesson doing that month after month after month of knowing where it's likely to go, but growing in my trust to get to the point where I can say, okay, I'm going to leave something on. And how do you do that? Take as much as you can off and leave the smallest portion you can leave on a trade open until it hits it or stops you out. That's the way you get to that trusting factor. How do you get through learning how to hold on to these trades to get to these targets, ICT. Because if I was up a little bit here, my mind would say to me, let me get out of this because it's uncomfortable and I'm scared it's going to turn into a losing trade. How do you get through that? You get through it by holding on to it. You put your stop in a position where preferably it doesn't gap up above your entry, and that can always be a risk. Every one of these markets can do that. So in that regard, stop losses won't work. But barring those instances, your stop loss moved into a position where if it moves up to you and before you entered, or better than where you entered, in other words, if you were short, your stop loss is below your entry, you are sitting in that position there and you have the smallest position open and you hold for it to hit your target and you don't trail your stop loss anymore. You just let it go. And you grow in confidence over months and years, folks. It takes years. These yahoos out there trying to tell you you can learn this stuff in a couple months or a couple weeks or a 1 week boot camp are full of shit. Okay. You can't. You cannot teach somebody how to get a 200 to 1 fucking trade, okay, in a 1 week fucking boot camp. And they're teaching you trading and they're only showing nano lots in their fucking live accounts. Get the fuck out of here. But you're reviewing that weekly candle analysis and referring to that economic calendar. So that way you know the stage is set and you're looking for something opposite to what you anticipate in terms of directional bias on that weekly chart. So in an example, say you are looking at the pound dollar for Forex traders, okay? Oh, he's talking about Forex. Oh, yeah. I've been tired of hearing about this S&P shit. Come on, ICT. Come on back home to Forex. Actually, I am home with commodities, but nonetheless. Say you're interested in pound dollar and you think that the weekly candle is going to expand higher based on your analysis on the weekend before the markets even open up. You think that there's reason for that weekly candle to go higher because it's been going higher and it's likely to go up to a specific old high or trade into an imbalance, a SIBI, or a fair value gap that's above price. Okay, I'll differentiate between SIBI and BISI before I close this, because I know some of you are probably chomping at the bit to dial in an ICT on the wire here and ask me what's the difference between the fair value gap, BISI, and a SIBI, and could you tell us the difference? And I will. Just give me a second, maybe longer than a second. But once you have that weekly in analysis and that calendar lined up, you now have a stage set for British pound likely to go higher. So you're in a buy model. And then there's a report coming out in the morning for pound as a currency. What you want to see is there a low on the 15-minute candle where sell side liquidity will be resting? Or if that low is really far away from market price, what is that? Well, it's relative to what your understanding about price is. There's no way for me to say it can only be this many pips. That's that gray area that experience is going to dictate. But if it's within, I don't know, 40 pips, anything more than 30 pips, I think is a much more meaningful move. And it's probably not a run for liquidity. It's probably going to just keep on going. But don't use it as a hard rule all the time. It's just a general rule or general principle that you can go by. And why do I use that? If you've studied my concepts with the Judah swing in London, where the London session usually creates the high or low of the day, it has a 70% likelihood of creating the high or low of the day. If you are in a sell model, and if you are in a seasonal tendency that's bearish, and it's an obvious draw on liquidity for sell side, all those factors being equal, then you do have a 70% likelihood. Because I see all these guys out there trying to run reports and statistics. ICT said it's 70%, and it's really not. I can see it's here that there's things that you didn't include. I just gave them to you right now. So go crunch your numbers. But those factors of looking for about 40 pips maximum is based on several things. And this is where you should be writing things down, folks, because if you're just driving down the road, chewing on your bubble gum and corn chips and shit, that ain't going to be good. You're going to have to come back and listen to this and write down some notes. Generally, from the open at midnight to the high of the day, it's usually within 30 pips that it makes the high of the day. Sometimes, in some weird instances, it'll go as much as 40 pips. Why 40? Because sometimes you'll cross and breach a big figure number, for instance, a 0, 0 level. Okay. And if that's the case, the algorithm can many times spool or spread beyond a particular level, run past it, in other words, as much as 40 points or 40 pips. So that's why I use 40 pips as a general rule. And if it goes beyond 40 pips, then it's probably not going to be a sell-off. It's probably going to keep going higher. Or it means I need to sit on my hands and do shit. Nothing. Just go back to bed. And then I'll trade the New York session. Okay, so I just tossed it in there, no extra charge. But using our example for pound dollar in the New York session, if we are expecting something bullish, our weekly analysis indicates that we're in a buy model. There's a high impact or medium impact news driver coming out at 8:30 or so in the New York session, all New York local time. Everything is always New York local time. Stop trying to take your shit in your chart and line up to your local time because it makes sense to you. Everything in these markets are always going to be on Eastern time. I don't give a fuck who tells you different. I don't care how long they said they've been trading. I don't give a fuck. Okay, that's all bullshit. Everything, all these algorithms is doing is running on New York time. Midnight in New York, that's the beginning of your fucking day. It's not Wellington. It's not Asia. Okay. It's New York midnight. That's the opening. Okay. I don't give a fuck. Anybody tells you different. That's the way it is. And you bring them, if you're here listening, you bring your shit and I will run right with you and I will run fucking circles around you and show you exactly what these fucking markets do. But you're going to fucking be schooled. So don't talk your shit in your little private little circles. Okay. Your little fucking webinars. Talking all your bullshit because you ain't getting the balls to come here directly. You do it right here and I will run circles around your motherfucking Mickey Mouse ass. Clown. UK boy. So once you have that, you're waiting for price to either drop down, no more than 40 pips, down to a low. But if it runs down below a low that's lower than 40 pips, you don't do anything. You leave it alone. You wait. Just let that go. But if there's a low that say it's at 40 pips, lower than the market price, before that news driver comes out at 8:30, you look inside that low to where the market price is now. There should be a price leg that has moved up. Is there a fair value gap in that? If there is, then you're anticipating now that the market drops down into that fair value gap and not below the low. Now, here is that point of contention that every student of mine has, even private mentorship students. They want the silver bullet answer that says, okay, here we are. We're at the brass tacks. This is where the rubber meets the road. ICT, lay it on me, baby. This is it. Hear that? That's excitement in your voice. You're talking to yourself, and I'm not in the room with you. How do I know, ICT, that I can buy that fair value gap and it won't go below the low? Are you ready for this one? Ready? You get your pen and your paper? Write down this. I don't fucking know. You don't know. That's why you put a stop loss there. Are you fucking kidding me? Yeah, that's it. But what happens if it goes down there and I get stopped out? What you do is you wait for it to create a short-term high. And then if it goes back below that short-term high, that's a shift in market structure. Wait for another fair value gap. Then you buy that one with half the risk that you lost on the first trade. If you lose on that one, you're done for the day. Done. How's that fucking complicated? It's liberating. You don't have to know. But if it does happen to you adversely, you know what you're going to do. And if it happens again as an adverse effect and you lose, you're done. You're fucking turning the charts off. You're done. That's your morning routine. You're done. You did your 2 trades. You've lost on both of them. You're done. Or the second one wins and you recuperate some of the drawdown, if not all of it, and maybe go into profit. That's the part that's going to separate all of you from the people that stick with this. Because if you can't accept the fact that you're probably going to lose and it won't change anything, it just takes a little bit away from you. Just like it takes away from your fucking gas tank when you drive to your fucking slave job. Okay? It costs you money to go to work, but you don't ever look at it like that. It costs you toll money to get to work, but you don't look at it like that. That's a fucking loss, okay? Your stop loss is getting hit every fucking day. As soon as you start that car up and you're driving down the fucking road, your stops are getting hit. It's costing you fucking money. You got to replace a fucking tire. You got to replace your tires. You got to change your fucking oil. Guess what? That's drawdown, baby. It's all about perception. You're running around with blinders on. You can't do this and not lose money. You're going to lose money. but you have to manage effectively how you lose it and come back from it. So you're going to do one of those two things. You're going to look for a swing low. Now, if it's less than preferably 30 pips, that swing low on the hypothetical example of pound dollar, I would, even if it had a fair value gap, I would give it the likelihood or the opportunity to trade below that low, especially if it's a high impact news driver. I would look for it to potentially run that low. But if we trade down to the fair value gap in that low, if it's less than 30 pips, I sacrifice that entry that would have been at the fair value gap because I'm waiting to see if it wants to take the low out. If it takes no interest in going below that low and it reacts at the fair value gap, then what I'll do is I'll buy the next down close candle as an order block. That's it. Isn't that straight to the fucking point, folks? Okay? You young guys, get to the fucking point. You can't get any more to the fucking point than I'm doing right now. I'm literally giving you IPTA step by fucking step, and you're still gonna fucking complain. Whatever. So what you're doing is you're determining if you're bullish in a buy model, you're expanding higher on the weekly candle, you're waiting for opposing price direction at the time of the news driver being released. Okay, so whatever, like an employment number or economic number that comes out, you're expecting the algorithm to reprice lower, and that's going to get all the retail traders wanting to go short. That's exactly what you want. That is the green light go you're looking for. You want to see something opposed to what you think the weekly candle is going to do at that time of that report. That's manipulation. That's the trick. That's the broken wing trick that the robin does to protect its little fledgling that's trying to teach how to fly. You ever seen that, a robin on the ground? And you see it, it sees you before you see it, and it starts chirping real loud, and it starts putting its wing out to the side like it's broke, and because it wants you to chase it. And once you get close to it, that fucking wing's perfect. It flies away and it's laughing at you. But you don't see the baby it's distracted you from. Well, the market does that same kind of thing. That's a Judas swing. It leads you down the primrose lane. It makes you think you're seeing something that's valid, but it's not. And it catches people that are offside because they're ignorant. They have no idea what the fuck they're doing, and they're chasing excitement. Just like a predator. They want to chase the thing that's running. Well, when the market runs, think about what that's done. You have all these people that are neophytes. They're traders that have no idea what they're doing, and they're just anticipating doing something next, but they don't know what it is to do because they're looking at these candles forming and they have no idea. But when there's an excitement and it moves really, really fast low, real quick, sudden, what does that mean? Oh man, I'm missing it. FOMO kicks in, fear of missing out on the move. It's already dropped 20 points. Man, it could go 100 points today or 100 ticks today. And I don't care if I missed the first 30. Let me just get in there right now at down 32 ticks. So you shorten, or they're shorting rather, into that move when you're looking to go long. That's smart money. That's what institutional mindset is. Okay. You're looking for the opposing view of what you're trying to do. That's that market efficiency paradigm. Remember month one in the core content? That's what you're doing. Smart money is a small little circle of entity that uses the greater community against themselves. But they have to have that smaller community to act as a counterparty. So they use enticement, they induce the excitement of seeing these big movements, and it trips them up. And they're rushing into the marketplace with liquidity. What are they doing? That big drop that occurs, let me say this. This might not occur in price. And if it doesn't, you do nothing. But if the market does drop, and all things being equal that I've outlined here, these are the things I would do to get into a trade. But that rush for retail or street money traders, the people that don't know what they're doing what? They're selling at the market. Sell, 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 sell. So what is actually occurring? They're drawing in and engineering sell side liquidity. Why would they do that? because they want to buy it. They have to have sellers at a lower price. Oh shit, the tumblers are turning, aren't they? Woo! You're getting there, aren't you now? You're learning some shit. Never expected that on a Sunday. Some of you are listening to me in your headphones right now, and you're wondering if the person next to you at the church pew thinking, did he just hear ICT, this holler and whistle? They're probably listening too. Don't worry about it. So you're looking for sell side liquidity when you're bullish in a buy model, in a Judas swing that's going lower in a high impact or a medium impact news driver, or you're looking for a BISI, a buy side imbalance, sell side inefficiency, where it's like a fair value gap, where the candle that we'd be focusing on would be a bullish candle. Okay. So fair value gaps are the classification. Okay. That's the imbalance. And to set this record straight, it is not in any George Engel books. There's a fucking clown out there trying to say that this is taught in George Engel. In fact, I'll fucking prove it to you. I'll thumb through real quick and show you there is no fucking reference to a fair value gap in Winning in the Futures Market by George Engel. Okay. I have the book. You can look at it too. It's on fucking line. It's not in there. $500,000. Find my shit anywhere before 1996 in print or in video, anywhere. You won't fucking find it. Go fuck yourselves. So you're looking for one of two things. If you're bullish, you're looking for sell stops to be rated or engaged. Or if you're looking for a fair value gap, preferably if you're trading Forex, it's preferably less than 40 pips below the market price. In other words, the market price being right before the news event comes out, or preferably below 30 pips. Okay, so that factor further increases. Let's assume if you're bullish and say London, we'll ring in London too, because this is what makes New York better, in my opinion. You have the added benefit of knowing what London has done. Let's now say that we had a previous late session low in pound dollar the day before New York midnight for today's hypothetical trading day. And overnight in London, we traded down below that, and then we had a nice reaction higher. And we drifted back down, and say that drifting back down is inside the leg that was created from the London low to the market price prior to the news report coming out at 8:30 in our hypothetical example where we would potentially be bullish on pound dollar. These things are further amplified in terms of odds in your favor, because now you have that likelihood of the London low of the day is in place. And now you're not going to see much of a retracement lower in that leg because they don't want to get close to that low. It's already locked in. So they're going to be reaching for a higher time frame buy side liquidity pull, or where that weekly chart's reaching for. It may not reach for it and arrive at it that particular trading day. It may require another day later in the week, because we're looking at a weekly expansion. The weekly candle is generated over what? The course of the week. That doesn't mean that it can't happen where the largest expansion occurred on that one single day, whether it be Monday or Tuesday or whatever one particular day it could have been. All the movement can be done with a report day, and then could be quiet, before or after that particular event. So you have to have all that factored in, which is why it's important to only be focusing on medium or high impact news drivers, because you will be less likely to miss the moves if you do that. Now, it doesn't mean you can't trade on days without high impact or medium impact news drivers. It just means that all things being equal, and whatever's in motion will tend to be in motion until we get to the report day. Or in layman's terms, if it's been bullish and a buy side liquidity pool hasn't been reached yet, if there's an absence of a medium or high impact news driver on that particular trading day, I'll still trade long. And that's fine. I just won't push my maximum leverage. I won't pyramid a lot in that particular type of day, because it might not create a lot of movement. So why should I build my positions large? I want to do that. And once I've seen the manipulation, it showed me its hand, like a poker table. Okay. I've seen my player's hand. So now I'm going to play mine strong. I'm going to go all in. I'm going to build and build and build, because I'm on side. I'm on the right direction because of my weekly analysis. It's indicated to me that they enticed the street money to come in going short at a time when I'm looking to go long. And one of two factors I'm looking for. I'm looking for sell side to be taken. If it's too far away to reach for it reasonably, then I'm looking for a fair value gap. If it doesn't have a fair value gap, here's a third. Okay, because just like on roulette, it's not red and black. It's red, black, and green. And green can fuck the whole show up. Green is there is no fair value gap, and the low is too far away to consider. It's beyond 30 or 40 pips below the market price. So what do we do then? You wait. You wait for the market to create another run higher, short-term high. It trades back down, and once it breaks that short-term high, now we have a shift in market structure. Follow the narrative. Do everything I just outlined before. Look for a fair value gap or a run below a low and submit to it. You might have to do a secondary trade with less leverage if you get burned on a fair value gap entry. But that's my 2-trade rule on it. And if I lose on both, I'm done. I have to wait for the PM session, or I just simply stop for the day. That's it. Is that complicated, folks? Now, for someone that's new, now I'm not going to be unreasonable here. For someone that's new, the terms I'm tossing out here and some of the logic I'm saying, if you've been around me for a while, you know, this might seem like, wow, this is really complicated. Just give me a fucking moving average, pal. Give me a moving average and a stochastics, man, and call it a day. This is too much PhD shit piled higher and deeper. No, this is algorithmic principles being articulated in a straightforward manner, right to the fucking point. You asked for this shit. Now you have it. What are you going to do with it? That's what I'm interested in. And then obviously you're just going to submit to the draw on liquidity based on that weekly chart. Now, there are smaller draws on liquidity in the intraday charts, and you see me referencing them all the time. Why do I do that? And why don't I do that with the weekly chart? Because that's the work you're supposed to be doing. How many trades have you seen me share? How many things have I articulated before I even put the trade on? I say, okay, here's the direction I'm looking for because I'm looking at a particular price level. I'll say, note this on your chart. So if it's above the market price when I'm tweeting that, is that bearish? Fuck no, it's not bearish. And there's people still out there thinking, well, why'd you go long? Aren't you bearish? What the fuck would I be looking to go short for if I'm pointing to something 30 fucking handles above the market price? How is that fucking bearish? That's an unrealized objective. It's below where market price is. That means I'm fucking bullish. I'm looking for a reason to go long. It might not be there yet, but I'm looking to get up there. Vice versa. If I say, here, note this on your chart, and it's below the market price, that means what? I'm bearish. I'm going to be looking for something. Looking for what? Some of this shit I just outlined here. Not limited to, but that's predominantly what I'm trying to do. Looking for a way to on-ramp and get a ride to that, okay?